The market is red, the news is panicking, and your portfolio looks like a crime scene. But while most people are hitting the sell button in a frenzy, the world's wealthiest investors are doing the exact opposite. Today, we're breaking down how to identify the best stocks during a downturn and which options have been the most reliable throughout history. But first, a mandatory reality check. This is not financial advice. Investing always carries risk, and past performance is no indicator of future results. This video is for educational and entertainment purposes only. What to look for. When the market drops, you aren't just looking for cheap stocks, you're looking for resilient ones. History shows that companies with three specific traits tend to survive the crash and lead the recovery. First, look for strong balance sheets. Specifically, check for low debt-to-equity ratios. In a downturn, cash is king. Companies that don't need to borrow expensive money just to keep the lights on are significantly safer. Second, look for essential moats. Does the company provide something people need regardless of the economy? Think healthcare, utilities, or basic consumer staples. If people can't live without it, the company can usually weather the storm. Third, prioritize positive free cash flow. You want companies that are generating real cash today, not growth companies promising profits 5 or 10 years down the road. Reliable options based on history. So, where has the smart money historically moved during a crash? The most common choice is the S&P 500. Historically, the S&P 500 has recovered from every single downturn in US history. It provides instant diversification across 500 of the largest companies, so you aren't betting on a single horse. Next are the dividend aristocrats. These are elite companies that have not only paid but increased their dividends for at least 25 consecutive years. They've proven they can grow through the dot-com bubble, the 2008 financial crisis, and the 2020 pandemic. Finally, keep an eye on value stocks. When high-flying tech stocks get crushed because they were overvalued, value stocks, companies trading for less than their intrinsic worth, often become the foundation of a portfolio's recovery. The strategy. The biggest mistake you can make is trying to time the exact bottom. You'll almost certainly miss it. Instead, use a trigger-based system or dollar-cost averaging. A simple strategy is to deploy your cash in tiers. For example, if the market drops 10%, you invest a portion of your cash. If it hits a 20% bear market drop, you deploy more. This ensures you are buying more shares when they're at their lowest prices without the psychological stress of trying to guess the exact day the market turns around. Conclusion: a market downturn is ultimately a transfer of wealth from the impatient to the patient. Do your own research, focus on high-quality fundamentals, and remember that the seeds of your future fortune are often sown during times of uncertainty. Once again, this is not financial advice, so please do your due diligence before making any major moves. If you found this breakdown helpful, hit that subscribe button for more market insights, and I'll see you in the next video.